All right, welcome in everybody. Get this going. I know it's going to take a few minutes for our friends on YouTube to be able to join us, but welcome into the AI Circle. It is the last day of July. This year has been flying. Anyway, hope everyone's had a great week so far. Hope you've been able to watch some Olympics if you're into that stuff. Other than that, we're going to go over the usual, but in case you have not joined us on the AI Circle before, and this is your first time, we have a little agenda that I will get to now. So we'll do a few announcements, talk about this pop-up, but the main reason why everyone's here probably is to not only get some questions answered by the iFlip team and more specifically Kelly, but also get your market update from Kelly and just kind of get his perspective on what's going on in the world. We'll also talk about, as he's smiling in the background, we'll also talk about any trades the AI's made. We haven't really made any. So there might not be much to talk about there, but with all that being said, we'll do Q&A towards the end of the call, and this will be your chance to be our Amazon gift card winner tonight. And I have full faith in you guys. We honestly didn't have many questions last week, so I hope we get some better ones this week. So anyway, I'll get off my soapbox. With all that being said, let's welcome in Mr. Kelly Korshak. Kelly, how are we?
I'm good. How are you, Lee? How is everybody out there in podcast land, I suppose? Lee, did we want me to? I can quickly do a disclosure.
Yeah, go for it.
I'm going to do my disclosure, which is, of course, anything we talk about today is my opinion, and my opinion only. That's what I do. I opine. This is news. This is information as I see it. Any inference about results or performance going forward or back is something that is understood. Everybody must understand that past performance is no indication of future performance. And so with that, we will get moving on my thoughts on the market and answer some questions. I guess I'll start off with, wow, what a day. The day is that the NASDAQ put on 566 points. That's the NASDAQ 100. Again, literally a week ago, the last NASDAQ lost 680 points down, like 3.7%. And then a week later, it decides to get back almost all of it, 3%. As you can see here, a week ago was this bar. We made a huge move down. We bottomed a little bit, and then we took a good rally today. The things that have been hurt, everybody should know, is literally the Mag 7. For the first time, the Mag 7 are really going through a correction, but mostly because the Mag 7, we all know, has had this huge mammoth run up in 2024. So Apple obviously was at 236, lost about $20. It's a mere 10% correction. Now it's coming back. It looks like Google, similar, 192 to 172, looks more like $20, another 10% correction. Meta, about another 10% correction. Microsoft, maybe a little more, as high as 470, down to 4, literally, maybe even wasn't even good today. Still in a downtrend, it looks like. Here in Microsoft, just so everybody knows, is also off another 10%. NVIDIA is literally from its high earlier in June, was at around 140 a share, got all the way down to 103. That's a 40, remind you everybody, a 40% correction occurred inside of NVIDIA. But with today's $13 gain, we've already recovered approximately out of the 40%, we've recovered about 18% of that. I'm going to just tell you, again, I'm going to opine. I'm not sure if this is a dip or this rally here is the beginning of a resumption back to the old highs in the Mag 7. That remains to be seen. Why is this happening? Before we go further, it is this. Something we've been keeping our eyes on. Look at the bond market. This is the 10-year note. This 10-year note for the first time is actually having a series of higher highs and higher lows occur. The market is moving up. Today, moving up means interest rates are coming down. We did print 4.11% on the yield for the 10-year note. This is because the market feels that at least one interest rate cut is imminent. The question is, what happens after the interest rate cut? There's an old thing we've always heard. It's buy the rumor and sell the fact. Well, a year ago, the rumor was there would be 6, maybe even 7 interest rate cuts this year in an election year. We've so far had none. The market, however, since bottoming in late April, is now completely convinced it's going to get 1 interest rate cut. So again, the markets do not, right now, the markets are not behaving in a way that's easy to manage. Hopefully systems do a better job, but even systems can struggle in this kind of environment where everything seems to be so easy. That's why these markets are just prone to problems in huge moves nominally, not percentage-wise. So percentage-wise, the markets are not moving any more than they ever did in 10, 15, 30 years ago. But what is happening is we see these bigger days. $500 NASDAQ days are, let's face it, that's a big day. 566 points. But it really doesn't look like much on a screen anymore, does it? I mean, this is the move. This little bar here of volume, that is a huge move nominally, but on a percentage basis, it means very, very little. It's no different than things used to be most of my career, which does now span over 40 years. The other thing I think is important to note is let's take a look quickly at some of the other indices, which have not broken down so bad. The Dow, which is my least favorite, was trying to print up towards its old highs. However, at the end of the day, fell back a little bit. But essentially, we're on the old highs for the Dow Jones Industrial Average. We are definitely on recent highs for the 10-year note. The dollar index, again, not doing anything. So there's nothing to be gained by looking at the dollar. If we look at the Russell has actually it did print newer highs today, and it's had this huge move that we saw when the interest rate cut thoughts started to come out about 2 weeks ago. The Russell, which was almost down on the year, if we look at it year to date, this is the year to date chart. Year to date, this is where the Russell was, this line right here in this little congestion area. When the rate cut came out, this move here was a 7.8% rally. This rally is a result, again, of the market thinking there's going to be an interest rate cut. Let me remind everybody of something I also learned, and you may have heard this before as well. Generally, when a market rallies, the first things that lead the way are the large caps, things that are like in the Dow or the S&P 500. And in the case nowadays, the Mag 7, those are the largest cap companies in the world. Those are the things that lead a rally. The things that trail in a rally are all the small stocks. By the way, that's the Russell. Those are the ones that don't participate in the beginnings of a bull market. However, they are the ones that participate at the end of a bull market. Kind of interesting to me, and why I personally remain standoffish with the stock market, is because when I see the small caps rally, I don't think that's the beginning of anything. I think of that as the end of something. These are always the last stocks to rally. That being said, over the last 4 years, we've looked at an inverted yield curve, incredibly rising debt. We came in to this over the last 3.5 years in the new administration. We have racked on $11 trillion of debt during that period, which is almost a 40% increase in the debt over the last 3.5 years. We have seen companies go to $4 trillion market evaluations in terms of NVIDIA or Apple. They've fallen back a little bit. But if we were to just take the Mag 7 and their market cap, that represents 1 full year of complete GDP almost of the entire country, which is about 30 trillion. It's just less than that. So we have an amazing thing going on that just 7 stocks can represent the GDP of the largest economy in the world just say about 80% of it, which is an enormous number. These are things that are out of whack. Inverted yield curves, zero interest rates, $9 trillion of government spending, interest rate increases to inverted yield curves, and yet the market shrugs it off as corporate profits seem to continue to maintain themselves. This is a very difficult time to navigate the stock market, and even including the bond market. My prediction, for what again my opinion would say, and my prediction says, that I would expect stocks to maintain current values marginally higher towards the election. I would expect that one interest rate cut to occur sometime before the election. Very unprecedented though, but it could still occur. If it doesn't occur, I expect the bond market to continue to rise, interest rates to eke lower. However, if it does occur, I think that'll be the end of it. I think we're one and done on the interest rate cuts for the year. How the market interprets that, I don't know. Generally, I would sell the fact. Once they make the cut, I would expect the bond market to go down in price. And I'll kind of explain why. The bond market, when they cut, it's sort of like a dividend. In that, I'm going to segue over to the oil stocks. Let's look at these. We all know we have a portfolio called Red Oil, and it contains ExxonMobil, Energy Transfer, All Plains American, and the energy ETF sector, XLE. Here's Energy Transfer. Hanging in there close to its highs of 16. Year to date, it's done extremely well. We are up from about 14 to 1630. So we're up about 22% here. If I go to the XLE year to date, again, something similar, 85 to 93. We're up about 10% here. We are also up, All Plains American, very similar outlook. We are up more like, here we're up more like 25%. And they're paying dividends. By the way, this is something interesting to note. Today was the ex-dividend day in All Plains American. You can see it. And what was the dividend? If you can see the screen, it was 31.7 cents. And of course, the market lost 42 cents over here. Always, generally on the day of a dividend, the stock will go down approximately the amount of money of the dividend, because that's taken from the cash balance of the account and moved over for payment. And so therefore the company stays about the same, but the cash is being distributed. So this stock, even though it's up about 24% of the year, this will be its second dividend of the third dividend actually of the year. There's one more. And the dividends we're paying currently about 7%. So they're really up 30% almost year to date, which is very, very good. Same thing with Energy Transfer. And by the way, same thing with stocks like ExxonMobil, which, by the way, is close to its highs. ExxonMobil also doing very well from the beginning of the year. It's up from 101 to 118. It's up about 18%, not including the two dividends that we've received. And the dividends here are now around 4.5%. So this portfolio remains good, and we're in this inflationary environment. I continue to suspect that it will. Some other things that I think are noteworthy as I ramble through this, let's take a look at Bitcoin through the proxy of IBIT. IBIT, of course, is an ETF that only buys Bitcoin, so it literally represents an exact chart at a different price of the Bitcoin market. Another thing interesting to note, BlackRock, who built this product, has bought literally as much as $2 billion of Bitcoin. I think you can Google it, and you'll see that their inventory is what they're using to sell and buy. That's how they create their exchange. The Bitcoin market here, this is the all-time high at about $41 a share. We're just about 10% off of that. It looks, I'm not sure if this is a large pennant to where we make a move back down towards the end of the summer. I'm still holding this market strong, and I still believe that this market has got much higher to go. And so I'm still bullish it. We were close to a signal the other day in the BitFlip portfolio to go 100% long, but it fell back and the opportunity was missed, which is good because it fell back. So again, this is working out well so far. Bitcoin is moving along. The 50% exposure is good in a market like this. We need a breakout to new highs to be able to see us get longer. In other words, buy the other 50% of Bitcoin. Let's see where we're at. Oh, let's go to a couple of other stocks I keep an eye on. I'm really following Sally Mae in here. I'm following Sally Mae because I kind of, this is Sally Mae, by the way, and this is Freddie Mac. Fannie Mae. These two stocks, of course, are how we get a mortgage in America in some way or another, or a loan. And instinctively, my thinking is there's a chance that these stocks, even though they're government operated entities, have a chance to go much higher if some laws are created by our government to perhaps lower the effective rate of interest on a mortgage. I've been hearing some rumblings towards that. I saw an article in the Wall Street Journal the other day. I thought it was interesting that stocks like this might go up higher in price because they'll open up loans to first-time home buyers. We'll see if that's going to be true in the future. But it was an interesting article. Let's move over to the S&P 500. It's always important to watch this. This market, the S&P, of course, have had an incredible run for this year. It just went through from 560 to 520. It just went through just like a small 6% correction. It looks like the correction's over with the move today. We will see if this will hold over the coming days. If it does, you can expect this thing perhaps to go up to the old highs or above. But I think we're either in a range here for the rest of the year, or there's a potential that if any hiccup occurs, I do believe the market is priced to perfection. And if it's priced to perfection, any bad news could send this market reeling. Let's take a look before we go. Look at some of the things inside of our portfolio. So let's look at the balanced portfolio. These are the items in it. Obviously, that had a good day. These are the stocks that we own or possibly could own. We do not own the S&P right now. That represents about 30% of the value of the balanced. However, and we also do not own Boeing. We do not own that, and we've also moved out of Burlington. However, all these other stocks we do own. And as a result, this portfolio is really performing well. We have some good weights into the energy sector. We do not own McDonald's as well. So when I look at this portfolio, this is a good place with good companies to park assets for the long run. It seems to be holding up very well despite having only approximately 65% exposure to the market. So it's really hanging in there relative to the S&P with only being 65% invested. That's a good quality. These are the stocks that are in the aggressive portfolio. Again, a smaller mix of stocks, more myopic. But all of these stocks too, I mean, you recognize them all. Here's MasterCard, for example. What a huge day that was. We've been moving down in this stock, but in one day, it seems like the world is all good again. Even though MasterCard didn't report, they had expectations of their earnings that came out. And earnings were just a match, but they were expecting something worse. And lo and behold, they rallied it hard, up 3.6% for the day. Again, most of the other stocks are all hanging in there close to their highs. This portfolio is doing a pretty good job as well, managing its assets. I guess we'll go to the foreign exchange markets, take a look at this real quick. Here's the dollar index. We looked at this already, nothing going on, but we are paying a little bit of attention to the yen. And lo and behold, the dollar has weakened against the yen. The yen has become quite a bit stronger against the dollar recently. And we were watching this market and the yen just literally pummel itself, literally from the last 2 years, year and a half. And finally, we're getting a correction in the yen. It remains to be seen if this is just a correction or the beginning of a new trend, but it is a large correction, moving from 162 to 148. That's a big move. The euro basically doing the same as the dollar index, just hanging in that tight range. I'll give you a better example of that here as I run out of breath. The euro is still trading at just 108. Good time to go to Paris. Good time to go to anywhere in mainland Europe because your dollar does get you go a long way. And remember, there's no taxes and no tipping on your on restaurants. Lee, I think I've kind of done a quick run over most everything. We can do some Q&A if you wish.
Yeah, I think you'll need a drink of water. That was a lot.
I do. I have it somewhere around here.
Let's get that away, and then Kelly, you're frozen, unfortunately, but that's all right.
I'll get that fixed again.
Wouldn't be an AI circle lately if we didn't have some sort of difficulty, but that's all right. Before we get into the couple questions we got in the chat here, and I'm sure there will be more that will come in. We did have one last time that we didn't get the chance to answer, so I'm going to start with that one. I paraphrased here, but basically this person's a longtime customer. They're in a lot of the portfolios that the newer folks might have never even heard of, like SPY, All Market ETF, S&P Beta Kicker. Their question was they're thinking of moving this into a core strategy and just wanted to get your thoughts on that.
Well, I think I'm back to be viewable.
Yep, you're good.
For now. Let's see how Cox Internet works out here. There's a few things going on. When we moved over the last couple of years to portfolios that have more meaning to people, conservative, we all know what that means. Aggressive, we know what that means. Balanced, somewhere in the middle, that we know what that means. Generally, when you have portfolios that have more things in them, you're going to have more exposure to the market. The good news is, if the market's going up and you have the exposure, that's a good thing, because generally all ships rise in a rising tide. The problem with that is that if you have the market is going down, it becomes more difficult to navigate, especially if you're buy and hold. Now, we aren't. We are managing that with a computer using machine learning and algorithms behind the scenes to be able to help navigate the ownership of the individual stocks inside a Smartfolio. Some of the older portfolios had 2 or 3 things in them, and they were very myopic. The good news about that is they are very good with managing risk in a down market. The troublesome news over the last year or so is they haven't been able to participate because the data that we use to feed the machine to tell it, hey, what the market is doing has been remiss this year. So for example, an inverted yield curve is something that the algorithms machine looks at, and generally in every other circumstance historically, it led to lower stock prices in the 6 months ensuing the beginning of an inverted yield curve. In this particular case, the curve has been inverted for about 1.5 years, and the market has gone up. Why? Well, this time, the only thing we can say that's different than historically is that we also injected the $9 trillion into the economy because of COVID. So all that money is just flushing out in there. But the data, like the inverted yield curve or credit card debt, which is also on the moon, that is used to predict the future price of the S&P, has been remiss this year. More than likely because, again, the amount of cash that the government on the fiscal side decided to add. Those portfolios, in the long run, they work. They work really well. They actually outperform the market in a great way. However, the market has certainly outperformed those portfolios over the last 15 months. Going forward, the best bet probably, if it's me, my opinion would be to broaden exposure for now. until the election, it's going to be very hard, probably, for the market to make any real move. They always say in the market that if they have, the less uncertainty there is, the more chance the market will go up. And the one thing we have right now is we have an election year coming up. There is going to be no acts of Congress to be able to affect the market, maybe other than the Federal Reserve, which is not Congress, lowering interest rates by one 25 bit cut. Other than that, though, there is no other things coming into the market. So it's possible that the market being free to move with no real bad news to come out, like earnings, maybe if earnings start to slow down or unemployment starts to kick up, which will be very hard because now we have so many extra people in the country, it's much easier to hire at a lower rate. So you have a lot of news now that looks to me like it's supportive of keeping a bottom on prices. So a broadening of a portfolio from, say, SPY Plus to, say, balanced would probably be appropriate, especially for the next 3-4 months before to the election and in what's left of the year. However, know that generally the markets don't behave the way we would like them to, and they're going to do something else. And my guess would be is if I own those things, I can tell you that your risk is going to be well managed. I should also point out this one last thing on that. All of our systems do use the S&P 500, and we have a special model in AI for that. And that has been an underperformer. However, we came very close about 2 days ago to buying the S&P. And I suspect if any down move in the S&P occurs, we will see that probably about 3 to maybe 4% lower. We'll get a buy signal is what I see and sense based on my inside knowledge of the data that it reads. And if that's the case, our risk would be about 6% at that time on any position we would take, which means most of our portfolios would be close to, say, 90% long or even 100% long. But we do need a dip in order for that to occur. So if it's me, you could either go to the balanced or something like that in the short run, or leave some there, because if it does dip, then we already know that those systems have outperformed in the long run much better than any systems we've had. And they're the ones that I've looked at most of my career. So I'm still in them, don't like the results, but I think we'll be bailed out of that pretty shortly, whether indeterminate of who wins the election. I think we're going to see some performance and movement in those portfolios relatively soon. We're very close.
Awesome. I'm seeing 4 questions. This one's actually not necessarily a question, more of a comment. But and it goes directly into what you just said. But this person is saying, as for the software you guys have delivered, I love it. It makes turbulence in the market feel more stable with AI. That is music to my ears. That's exactly what we're trying to do, right, Kelly?
It is. The whole idea is to take emotion out of it. I can tell you that simple algorithms in my lifetime have outperformed the market in one or two ways. One, they just literally outperformed it by just even a few percent. That's great. But the more important thing to me has always been, because especially now that I'm older, has been that they manage the risk a lot better. So I always tell you this, Lee, that if we could get to the same destination and one person's the hare and the other one's the turtle, the turtle is very likely not to get in an accident on its way to its destination. And so where the hare, although being much faster, is more likely to get in hit something or get disabled. And I kind of look at the markets as you have a choice to be the turtle or the hare, and the turtle is always better. The turtle does win.
Yeah. Smoother journey.
It's a smoother journey, and that's what I care about. And I think everybody at some level should care about risk-adjusted return.
Yep, absolutely. Question from Gloria, and hopefully I'm interpreting it correctly, but she said, I have a question regarding if a Roth IRA can be combined in the same account but separate because of two different regulations. I'm understanding that's possible. I'm speculating here. So you can have, you could have a Roth IRA, say at Schwab or Fidelity or both, and one with us. Like technically, it's all one IRA or one Roth IRA. You can have them in different areas. You can't necessarily have two Roth IRAs and max out both of them. I don't know if that answers the question or if I'm understanding the question correctly. But Gloria, feel free to chime in and maybe make it maybe just ask the question a different way.
Yeah, I can't quite understand that one either, Gloria.
Kamal with some good feedback for you. He said when you were talking about what was it, Plains All American or Energy Transfer, the one that paid the dividend, talking about the drop in the stock price and the dividend amount that was paid. I didn't know that until you actually said it a while back as well. Next one. The gist of the question is how to prep the portfolios for various election-induced scenarios.
Read that again. I'm trying to find. I see the questions too. Read that again.
So it's I'll read the whole one. It says Ray Dalio says worst case scenario for the election is closely contested Trump loss, possibly civil war. How do you prep a portfolio for various election-induced scenarios?
Good question. Wow, that's actually a real good question. I actually would agree that with Ray Dalio. Ray Dalio, for everybody's knowledge, is the CEO of Bridgewater. I don't know if he stepped down, but that was the world's largest hedge fund. By the way, most of Bridgewater runs in very similar ways to Flip. Some of those kind of ideas, they are incorporated. The ones we use are incorporated at Bridgewater. If that scenario were to occur, that is definitely bad for the stock market. Obviously, the mattress looks pretty good if there's a civil war in this country as a result of a contested election. The only way to prepare for that is to be able to have cash. And again, the election results nowadays, because they're always so close, they don't occur generally sometimes until like a day or two later. I mean, before we used to know on the evening of November 6th, that first Tuesday, who the president was going to be come January 20th. We no longer know that. And that means you have this period of time between the election and the next president of possible deep stress to our systems, our government, our bureaucracies. Everything would be tested. It's possible. The only way I can answer that is cash. I think cash is probably the king at that moment. And that's one of the reasons why I'm in no hurry to try to make money in the next 3 months, thinking I'm going to miss out on anything, because the next 3 months and the 3 months after that, going into the change of office, hopefully I would like to see a better administration, I think, than the one we had. But politics aside, I think we're in dangerous territory for the market. I mean, I hope people can sense my tone that this is not a movie I've seen before, and I don't know the conclusion. I look at it as if this is brand new, and it is scary. So cash is the answer to the question. I'm not looking to make money in a turmoil. I'm looking to keep it.
Perfect. The next one is from Brian. Paraphrase a little bit. If you create your own portfolio and the AI is not tied to a stock or ETF, will it start learning that particular asset when it's in the folio? Example, SCHG and AVUV.
No, I can answer that directly. Yeah. No, it doesn't. So just because, look, a lot of people create their own smart folios, or they put their own symbols in just to own them. Just because we see particular accounts that have stocks in them, whether they're manually owned or in a custom portfolio, doesn't mean that we're using them to what we call map. Map means we take it and then we apply the machine to that symbol and all of its data to see if we can discern something from it. The way we do it is through suggestion. Generally, a lot of our customers have ideas or stocks that they like, and they'll send that off to Lee or someone on a ticket to say, hey, are you guys looking at this stock or that symbol, or et cetera? And that'll get back to me about us. And then I take a look at it and see if that's something worth mapping. If it's worth mapping, it means, yes, I'll put the machine to work on those stocks. So, for example, in this case, SCHG.
It's a Schwab large cap ETF, by the way, and then AVUV is a small cap, some other company.
Yeah, I'm just going to write those symbols down, and I'll actually take a look at them. One key piece of information is we do need to have enough price data to work with them. So a lot of the stocks that are new, we don't have the price data. Like, I'll even give you an example, IBIT. It's a brand new ETF. We know what it is. It's Bitcoin. So obviously I could trade Bitcoin and then trade the IBIT. But if it's a stock, I definitely need the stock data, the price data, to be able to compare with the certain fundamental data that we look at and see if we can find if the machine will find the patterns. And if we don't have enough price data, obviously we can't find any patterns.
Perfect. So, the only thing I want to clarify on what you said, because you can, like Kelly just said, you can buy a stock manually. The AI is not going to interfere with that in any way. So both of those stocks that were named there, you can actually buy, 10 shares of if you want to. The AI is not going to touch that. You can also, what Kelly was saying, create a custom smartfolio. So you just basically pick the stocks that you want the AI to manage. I don't think this is a downside, but I would say the only downside is you can't just buy everything under the sun under that. We have what, Kelly, roughly 650 something stocks that we've mapped the AI on. So, correct. Which is plenty.
It's really enough. Keep in mind that if we're traders, we always look at what we think is the next tip. So you hear a symbol, they say, this is a great symbol. There's a symbol, it's going to be a data center. It's going to be this, it's going to be that. And those to me are tips. What we do, the reason we have 600 stocks or more, actually 640 or something, it's because 500 of them are the S&P 500. Those are things where we know we have lots of price data for. And in order for us to determine direction of price, future price, we have to have the old prices and relate that to the data that the machine had at the time to see if we can associate other data streams with old data to predict price.
Right.
So that we have those 640 because there's enough data, price data behind it.
Yep. Without data, there's no
way
out. It's a shot in the dark, right? It's a guess.
Yeah, it's sort of like data for a brand new baby, right? The baby just got born. There is no intelligence yet.
Sure.
It takes time to train it. So the kid has to be at least a few years old.
Well said. I do want to get through these couple more, and I know we're running out of time. So let's. So Dean, do you think the surge in, it looks like 3M, is one-off covering shorts or any indicator of something bigger, broader? I'm not sure if you followed that at all.
I don't, but you know what I'm going to do? I'm going to just quickly take a look at it. I saw some movement on 3M. That's obviously data-driven. That's data-driven all the way. I can't tell you if that's a one-off. I got to read the news on it and see what drove this stock to go up 27% in a day.
Perfect. Gloria, why don't you reach out to me directly? I know you have the IRA Club account. This might not be the setting to answer your question, so I'm sorry. But happy to help nonetheless. Julius, what have been some of the cheapest, best performing dividend stocks? Plains All American, Energy Transfer. I just looked at my account the other day, and I've had, I think it was Energy Transfer since it was $10 or something like that. It was up 60 something % over the last couple of years. Like,
well, the best dividend stocks are generally always oil companies The next one are real estate companies historically. Oil companies, because we know we have the revenue, there's a supply demand issue. The good news about in real estate companies, because again, there's rental incomes. A good example is American Tower, AMT. So real estate can be leased out and you get revenues that you can then take those revenues and pay a dividend. Energy, same thing. You mine it from the ground, you have a product, you sell it out, you know you got a captive market, there people are going to buy it, so that you know you have cash flows and you can send them out as dividends. Here's the downside of dividend stocks, which I'm still a big believer in, especially now, is the downside is they're almost always related to a commodity, something that is volatile in underlying price. The energy markets have been held up high for a long time because of the existing administration. So the good news about the Biden administration would be that they're anti-oil. Well, that's kept oil prices way higher than necessary. And it's also made the infrastructure of certain kinds of oil companies even more valuable under a different administration. So here's a thought on that. Always know that if you want dividends, you generally have to look to oil and real estate, the only kind of companies that have the cash flows to offer persistent, continuous dividends. The problem with them, though, for example, if a Trump wins the election, what you're going to see is you will see lower oil prices. Lower oil prices will translate into possibly greater demand, but at a much lower price. It could lower the dividends in that environment and the prices. So we're in a good spot with the energy companies through the election and probably somewhere into January or February of next year. And then we're going to want to really revisit that. So red oil is something that definitely learns on all the stocks in there. And so we will see what the AI has in mind for those kind of stocks. But just to kind of put a cap on it, I can tell you that I'm still very much behind the energy sector, and because it pays and it's going up, and I still think there's room in it.
Perfect. My only thing I'll add, just because I heard the word cheapest and we talked about oil, I've seen some OTCs, China Petroleum, something that's 59 cents. It's paying 15% dividend. And you're like, obviously we can't give advice, but I'd probably stick to the U.S. markets.
I totally agree. I mean, look, if it exists overseas, a lot of money managers believe you should have your money distributed all over the world. I say no. Any pro that I ever saw do it, they don't do that at all. Because today, everything does revolve around the United States. Our companies set the trends. Most money capital flows come into this country to invest in U.S. domiciled stocks. So if that's the case, why do I care about having a component offshore when I can get the same thing with a domestic product, a domestic symbol?
Perfect. Kelly, I know we have a handful to choose from tonight. Feel free to look through. You depends on the direction you're wanting to go.
I like the question that Brian Williams came up with, because that is a good thought. When you do add a stock into a custom portfolio, does that stock, do we start looking at that stock to see if we're going to learn and be able to model it? The answer, of course, was no, we don't. But we do know all the symbols that are on the portfolio, and periodically I scan them for something that is interesting. I have a way of scanning them to be able to say, which of these stocks are moving, what could have motivated the customer to buy that. I've looked at a lot of steel companies thanks to one of our users, and I'm trying to see if I can model some of those, which we don't model unless they were in the S&P 500. So I'm going to give the gift card reward to Brian Williams.
Perfect. Brian, congratulations. And I think it was a very thought-provoking question and answer, though, as well. There was a couple others. I just didn't know which direction you wanted to go. So, Brian, as the screen is showing you, just send an email to mailbag@iflipinvest.com. Either give us your account number or just a screenshot of your account. and then we will get the gift card sent your way. Other than that, just closing thoughts. We didn't really get into my couple announcements. I don't want to keep you guys too much longer. Previously, we talked about the pop-up when you guys log into your account that you might have to upload your picture of your ID. Those of you who didn't have to do it before probably have to now. So just when you get a chance, log into your iFlip account. If you see a pop-up that says something to the effect of ID verification, it's a very simple process to do. You just take a picture of the front and the back of your license, but we do need that. So go check on that. The last thing was, you might see when you do log in that the home screen has a new look and feel to it. It's nothing crazy. We're just making it a bit simpler and easier to understand. And we've taken your guys' feedback and making the platform look a little bit different. And there will be other modifications to come. So stick with us, but I guess I didn't want any surprises of like, oh, where's this button that I'm used to? So that was, I think, it on my end. Brian, congratulations again. And then, as always, our next AI Circle is going to be exactly 2 weeks from today. So that'll be August 14th at the normal time. So thank you all for joining us tonight. Thanks, Kelly, for all your insights. And